Second question. Is there anybody here? A lot of people on. Am I not sharing my screen? Okay. I don't know why that happened. Is there any, so let me ask you the second question. Who's picked a company for your project already? So good, more hands are going up. As I said, get that process rolling. So this nag will continue until morale improves and you've actually picked a company. So hopefully by the end of next week, I won't have to ask this question again. Last session, we were talking about how the utopian objectives of corporate finance kind of break down. We talked about the assumption that shareholders have complete power over managers and that managers therefore go out and do what's in the best interest of shareholders is false. Because shareholders don't have that much power over managers. The annual meeting doesn't work that well. The board of directors often thinks its job is to protect the CEO, not to protect the shareholders. And what do managers do? They put their interests ahead of shareholder interests. So today I want to take the second big assumption that utopian corporate finance makes. Remember, we assumed that when lenders lend money to a company, that the company doesn't take advantage of them, even if it's left loopholes the size of a Mack truck. Why? Because you worry about your reputation, you've given promises, you keep the promise. This is a very rosy view of human nature. The reality is, if you leave loopholes, you will be exploited. Not a question of when you get, whether you get, it's when you get ripped off. Let's talk about why. Lenders and shareholders in a company can have very different interests in the company. So you guys play the role of a bank. It's a less fun role, but I'll let you switch roles later. You guys are going to be shareholders. Right? We're going to go try borrow money from them to take projects. You ready? We trek over to the bank and we first proceed to describe whether our projects are risky or safe. So when we're talking to the bank, how do we describe our projects, that they're safe or risky? Absolutely safe. Everything's pretty much guaranteed.
Professor, we can't hear you. I'm sorry. We can't see anything on the camera in the classroom.
You see it now?
We see the lecture, but that you share, but not the classroom. No.
Well, just look, if you can see the slide, that's all that matters. So I don't know why it's not showing up. It's,
Okay, thank you.
yeah, I can see the. This is weird. I'm definitely not putting it back. I hate those. So let's think about what happens now. So you described this project as incredibly safe. Let's say you have a trusting banker, which is an oxymoron. Because you know what happens to trusting bankers, right? They don't stay bankers for very long. You look at the equity investors, you guys look like you have honest faces. You must be telling me the truth. And you lend them the money with no strings attached. Horrifically bad mistake that you've just made, right? Because now I'm going back to the fund role. I'm now going to become a shareholder. We now have your money that we told you we're going to take really safe projects with. But now that we have your money, maybe our incentives are going to be a little different, right? Instead of taking safe projects, we're going to take risky projects. Why? Because if there's upside, we get to keep the upside. If there's downside, you get the downside. In fact, we might take all the money, go to the racetracks and put it all in number 5. If it pays off, we get a huge upside. If it doesn't, what do? We declare bankruptcy and it's limited liability, take the assets, we have no assets. So the first problem you're going to have, and we're going to come back and address this more fully when we talk about debt versus equity, is lenders left to their own devices will want the company to take safe projects, but equity investors will want to take riskier projects. Second, once we've decided to take projects, we can go out and borrow more money on the same asset, right? But if you had a choice, you wouldn't want me to do this because you don't want more debt in this company because more debt makes the company riskier. In fact, we might give future lenders first claim on the assets if you haven't protected yourself. So you can already see the game come into play. I'm going to take riskier projects. I'm going to try to shift the risk from me to you. I'm going to try to borrow more money. So let's go back to you. Remember, you were a trusting banker. You've now become a cynical banker. So when I tell you that I'm going to take really safe projects, you don't believe me, right? You build in covenants and constraints. We're going to come back and talk about how that plays out in corporate finance. But if you don't protect yourself, you are going to get ripped off as a lender. Now, the old defense for a long time was if you're lending to a reputable company, a company that's been around a long time, maybe you don't need these protections because they wouldn't do something like this, right? They've been around 100 years. So let me tell you a story. It's a sad but true story for lenders. It's about a company called RJR Nabisco. So it's the 1980s. Let's say you're 65 years old, you're retired, you moved to Florida. You live on a golf course. Doesn't everybody? You've saved $300,000 for your retirement, which at that time would have been sufficient. And I'm going to play the role of your broker, the stockbroker. You come to me and say, look, I have $300,000 to invest. This is my pension money. I want you to invest in someplace safe. I say, how about a nice mutual fund? I say, well, stocks are a little risky. So, okay, we could buy some government bonds. So that sounds good. But then I tell you the rate you're going to make. I say, that's not going to be enough for me to cover my lunches and my golf course fees. Could I make something a little higher? So how about a nice corporate bond? Initially, you're a little wary because corporations do default. So no, this is a really safe corporate bond. It's issued by a company called RJR Nabisco. You've seen it, right? So I've seen it all over the grocery store. And then to make you feel completely comfortable, guys, you got to mute yourselves. As long as that didn't mute me, right? Jesus. Okay. And to make you feel completely comfortable, I hit you with the final piece of evidence this is a really safe company. I tell you that this ratings agency called S&P has rated Nabisco as a AA rated company. You have no idea what I'm talking about. But they say no AA rated company has ever defaulted while it was rated AA. I'm a very careful broker. That is technically true, that no AA rated company has defaulted while it was AA. She said, that sounds good. Put the money in there. So I put you $300,000 in Nabisco in 1984. You collect the coupons and the interest. You like me as a broker. Then one day you wake up in 1988, and here's what you see in the Wall Street Journal. You see a news story that says that some outfit called KKR has bought RJ Nabisco in an LBO. You have no idea what all these acronyms even mean. So you call me and I tell you, look, don't worry. Nothing has happened yet. But here's what KKR, this New York-based private equity outfit, has done. They've gone out and borrowed, that's what an LBO is. You borrowed a ton more money on the same company, and they've taken the company private. But your bond is still there. It's still intact. You have the same coupon rate. There's been one small change, though. Remember that AA thing that I talked about? You're still in the alphabet, but you've slid a little bit. It's now BB. You know what's happened overnight, right? You have the same bond, the same coupon, but now there's a much greater risk that you will not get paid. So how does it show up? On the day that KKR did the Nabisco LBO, on that one day, here's what happened to the RJ Nabisco bond. It lost 20% of its value. Remember the 300,000 you had? It's now 240,000. We're going to introduce a new word into the English language that we're going to use in this class. If you lend money and you don't protect yourself, you risk being Nabiscoed. So whenever I say the word Nabiscoed, I want you to think about this chart, which is you're a bondholder, you're a lender, you don't protect yourself. I don't care who it is, you risk being Nabiscoed. So file that away. Utopian corporate finance, this would never happen, but in the real world, it can. Let's move to the third assumption we make in utopian corporate finance. In theory, financial markets are efficient and rational. Market efficiency is one of the most misunderstood concepts in finance. We'll come back and address it. But in an efficient market, the market's not always right, but it's trying to incorporate all the information out there into the stock price. And if you have a truly efficient market, here's what you should see. A company should be rewarded if it takes good projects. Its price should go up. Playing short-term accounting games should have no effect on your value. So if I play some accounting game, make my earnings look better, the market can see through it. And stock price performance becomes a good measure of whether you're creating value. It's an efficient market. That's what utopian corporate finance assumes. It doesn't assume that markets don't make mistakes, but that the price incorporates information and moves because there's new information. But the reality is, and we all know this, including the people who claim to believe in efficient markets, there are some holes in this assumption. In fact, let's look at some of the holes. The first is that assumption about managers who never lie, who reveal information honestly and on time. That's not real. Managers don't always reveal information on time. They don't always tell the truth. Why? Because they're human beings. I'll make this personal. I've been married for 36 years. Anybody here married? Okay, let's assume that some bad news comes in during the course of this day. You get home this evening, you open the door and say, "Hon, I have some bad news." No, that's not what you try, right? In fact, if you have bad news, you try one of two strategies. One is you wait for a good time. Not now, window open, closed again. Maybe when he or she is sleeping, your spouse, you whisper the bad news. And they say, I told you last night when you were sleeping, I didn't know that. So the first is you try to hold off for a good time to reveal the news. The other strategy that you might try is to bundle the bad news with some good news. The bad news is, as I was driving to the train station this morning, I was looking at my phone and I ran into a tree. Oh, by the way, switch to Geico. Completely disproportionate, but you're hoping the good news cushions the blow. Do companies try something similar? Absolutely. When companies have bad news, they try to find a good time to release that bad news. You're human beings, you wait for your spouse to be sleeping. For the company, what's a good time to release news? When the market is sleeping, right? I'm going to show you a chart and I'll come back to this. About 30 years ago, when I had to get published to get tenure, so I used to do all these papers that nobody read, but you get published. And so one of the useless pieces of research that I did was I actually looked at earnings reports from companies and dividend announcements from companies by day of the week. Very profound research, right? But basically the data is there. Might as well ask the question, is there any difference between earnings reports on Monday and Tuesday and Wednesday and Thursday and Friday? So the way to read this graph is a typical earnings report on Monday. That's a change in earnings, change in dividends, good news, good news, good news, good news. Monday, Tuesday, Wednesday, Thursday. Something terrible happens on Fridays. And then I took a closer look at the Friday announcements. And guess when bad things happen to companies? 4:01 p.m., 4:02 p.m., 4:03 p.m. Why? Because the market closes at 4. If you don't believe me, just watch news stories on Friday evenings after the market closes. Remember that London whale thing that happened to JP Morgan? They lost like billions of dollars. When they announced it 4:15 p.m. on a Friday. What are they hoping will happen? That you'll forget about it by the time the market opens on Monday. That never happens. So guess how this plays out? For the last century, the worst day of the week to invest in markets has been Monday. There's a reason for that. So the first is information doesn't come promptly to markets. Companies try to they manage information. Everybody does it. Politicians do it, governments do it, companies do it as well. So information gets delayed. Do companies sometimes lie? Absolutely. I think that's the exception rather than the rule in US markets, but it does happen. I'll give you one of my favorite examples. In the late 1990s, there used to be a company called Bre-X, it's a Canadian gold mining company. It was one of the most highly sought after stocks on Wall Street, lots of buy recommendations. It claimed to have found the biggest gold reserve in the world somewhere in Indonesia. In fact, one of the ways the legend of this company got formed is they actually flew equity research analysts. At that time, most equity research analysts following these companies were in New York. They flew them from New York to some remote part of Indonesia. And before the plane landed, they actually salted the earth with gold dust. And when the analysts landed, they said, look, there's so much gold under the ground, it's coming out. Now, let's face it, most gold mining analysts in New York have never seen a gold mine. They have no idea how it works. So they believe, they come back and say, there's so much gold in this reserve, it's coming out of the ground. And something tragic happened. The geologist who worked for Bre-X jumped out of a plane at 32,000 feet without a parachute. And this doesn't end well. And then people start asking, well, why would he do it? Was he depressed? And in the months after, news starts to come out of the company. They said, we told you there were 30 million ounces of gold. It's really 15, it's 5, it's 1. And finally, they admitted there was no gold at all. The whole thing was a long-term scam. That's outright fraud. Or another example is a company in the late 90s. It's a Wall Street Journal article I read, and the company says it cannot find its CFO. That's what the news story says. XYZ company says they can't find their CFO. Remember, these were the days before smartphones. You couldn't track people. So you keep reading. He's gone. We checked his apartment. We checked his office. And at the end, it says, oh, by the way, half our cash balance has also gone missing. So somebody somewhere is having a lot of fun. And it's not your shareholders. That's outright fraud. So the reality is, information doesn't come to markets at the time it should, and sometimes managers lie. So that half of the equation breaks down. You're saying, what about markets themselves? Let's face it. Markets are not rational and cool. In a rational market, when Mr. Big fell off his exercise bike, would you knock off 10% of the market cap of the company that makes the exercise bike? I don't think so. But that's exactly what happened for Peloton, right? The guy, Mr. Big on Sex and the City falls off his bike, turns out to be a Peloton bike. He dies. Next day, the stock is down 7%. You say, what? I do think in finance, we're very casual about assuming rational investors. And I have a test. It's a test I've used for a long time. I'll lend you the test. You can keep it if you want. For rationality. It's called the Elvis Presley test. Let's start with the first part of the test. How many of you think Elvis is still alive? He'd be like 100 years old. But I think a few people might be holding on to the thought that he lives in Upper Michigan somewhere. He's still making songs, but one of these days he'll show up. But the truth is, Elvis has been dead for a long time, like late 70s. Second part of the test has nothing to do with you. You can relax. You know how USA Today is like the McDonald's of newspapers. If you want to read all of the news in like 6 minutes, you can read the whole paper. There's nothing of depth. It's designed that way. But every day they run a poll. And when you run polls for 260 days, they don't print on weekends, you run out of questions to ask. So they start asking questions like, do you like lettuce on your burger? And 71% of Americans say yes, 22% say no, and 7% say, I don't know. Have you noticed this about pretty much every poll? There's a floating 7% who just don't know. Americans were asked, do you know your name? 93% said yes, 7% said, I don't know. It's a very paranoid group saying, don't ask me any questions because you might hold the information against me. So in 1992, for the 15th anniversary of Elvis's death, I don't know, 92 or 93, USA Today runs a poll. Do you think Elvis is still alive? 15 years after his death, 73% of Americans say, yes, no, he's dead. I mean, we've read the story. We know he's dead. 20% said, yes, he's alive. I've been reading about it in the National Enquirer, the Daily, whatever your publication of choice is. And 7%, of course, said, I don't know. Let's set the 7% aside as paranoid and rational. Remember, the two are not mutually exclusive. Maybe it's the rest of us who are being irrational. And think about the fact that 20% of Americans in 1992 thought Elvis was still alive. Let's take that 20% today. That's 20% of what, 300 million people. That's 60 million people walking around thinking Elvis is still alive. Next time somebody talks about rational markets, or ask the question, how do you explain the fact that Netflix dropped 22% after that earnings announcement? and you're searching for a rational explanation, remind yourself of the fact that there are 60 million people walking around thinking the equivalent of Elvis is still alive, something else right now. And what do you expect them to do? New story comes out that they sit down and rationally project out the cash flows in the next 10 years, adjust for risk, and then react? I don't think so. In corporate finance, often we make statements. We make statements like, if you move from 10% to 30% in your debt ratio, that's good for your company, your value will go up. Stop right there though. Because if the CFO then says, if I do this, will my stock price go up? You know what your answer should be? There are 60 million people walking around thinking Elvis is still alive. They're all in the market. What happens to value and what happens to price can be very different. Corporate finance is about maximizing value. Who knows what maximizes prices or what reduces prices? So when you ask people, are markets efficient? I'm going to ask you that question because each of us comes with priors about what we think about markets. There are people who believe that markets overreact to good news and bad news, like the Netflix and Facebook earnings announcements. There are people who are very conspiracy minded. They believe that this whole thing is a conspiracy. That's basically what's driving those Reddit groups that essentially keep complaining about the fact that GameStop is not going up anymore. They can visit this cabal of hedge funds that meet together every week in New York and plan the demise of the people on Reddit. You put 5 hedge fund managers together in a room, they're all stabbing each other in the back. They're not conspiring to bring in some Reddit group, but there is a view that this whole thing is insider driven, that prices are manipulated. And there's also, and this is, I think, the argument I want to talk about the most, that markets are short term. You know what I mean by short term? That prices react to what happened most recently, that they don't reflect the long-term value of the company. Now, you can already see my priors, but forget about my priors. I want to ask you about your priors and get them nailed down. Because as we go through this class, these things are going to keep coming up to the surface. So I'm going to read a series of statements to you, and I'd like you to make your honest judgment. Don't try to figure out what I want you to answer. I want you to, based on what you feel about markets, know about markets right now. Give me your answers. So here's the first one. When companies focus on market prices, they will tend to be short-term in their decision-making. That focusing on market prices leads you to be short-term. So agree with the statement. Do not. How many of you agree with that statement? Okay. And that's often in fact, that's the basis for all of sustainability, right? Because what's the argument that people who believe, they believe that focusing on market prices has led markets to be short-term and that you need them to think past the market price. Okay, so I'm going to ask you a second question. Letting managers make decisions in a company will lead to better long-term decisions. So basically, forget about the price. Remember, somebody's got to make decisions. So if it's not market price driven, managers might be the ones you trust. And of course, advised by consultants and sustainability experts or whoever they bring in will lead to better. Agree or disagree? How many of you would agree with that statement? There are a few, but a lot of hands that went up when you said, I don't trust markets, didn't go up when you said, I trust managers, right? So if you don't trust markets and you don't trust managers, which is where a lot of you are, then I'm going to give you a third choice. Somebody's got to be making the decisions. So neither managers nor markets can be trusted. Should we have governments and regulations and laws then drive decisions? So that's a third choice. So if you let regulations and laws be written, will that lead to better long-term decisions? Agree with that statement, disagree? How many would agree with that statement, that the way to make companies behave better long-term is to either regulate it, write a law about it, or have some kind of entity out there making decisions that override the company? We are in big trouble now, right? because we basically are saying we don't trust markets, we don't trust managers, we don't trust government's laws, regulations. So where the heck do we go? I mean, how do you can't just pick a void. There is no, what I'm trying to say is there is no perfect solution everybody is going to have. And the question you got to ask is which one leads to the least short-termism, right? Basically, they're going to be short-termism. I mean, what's going to cause managers sometimes to be short-term? What do managers think about? What's in my compensation package? What are my options? When do I vest? And if you're going to vest at the end of next year, you know what you're going to try to do, right? You're going to try to push up, do things this year to make your market price go up, even if it's bad for you in the long term. You're saying, but government should be long term, really? What's the time horizon of a democratically elected government? It's 4 years in the US when you start, but it gets shorter and shorter. It's the next election cycle. This notion that governments are somehow, unless you're the Singapore government, which is kind of oddball, governments are not long-term either. So when people are quick to jump on markets and say, they're short-term, we shouldn't look at market prices. My question is, okay, I can see that, but who should we use instead? Who should we trust instead? Because there are no perfect substitutes, every system comes with consequences. And I'm going to talk about the German and the Japanese system, but Japan, in the last century, had a very elite group of people running the Ministry of Finance. They were the very best and the brightest. And their job was to tell Japanese companies which directions to go. And Japanese companies actually listened. And it worked for a while, right? Until that entire elite group screwed up. There's a danger in letting a small group of people, even if they're well-intentioned and have expertise making decisions, because they won't necessarily be the best long-term decisions. But I want to counter this notion that markets are hopelessly short-term. It seems to be the prevailing wisdom. Look at how many hands went up. And it's often based on anecdotal evidence. Let me give you some counter evidence. None of this is conclusive. I'm not going to be able to prove that markets are long-term, but I want you to think about this the next time somebody says markets are short-term. In a short-term market, if all people cared about was earnings now, how do you explain the fact that the highest price stocks in the market are not mature companies that deliver earnings right away, but companies with no earnings and lots of potential? I told you that you can give me another read, but it clearly is not consistent with the market saying, I want everything and I want it now. Second, if in fact markets are so focused on make money for me now, and you look at the pricing of companies, you know which companies should be overpriced? Companies with a lot of earnings now. And which companies should be underpriced? Companies with everything in the future. In fact, you get the exact opposite in this market. The companies that are being underpriced are mature companies. The Kraft Heinz, the Coca-Colas of the world. The companies that are being overpriced are the companies that everything is in the future. And there's a third piece of evidence I'm going to offer you on why you shouldn't be so quick to judge markets as being short-term. Let's say I am a technology company. I announce a major R&D investment I'm going to make to be in AI, because that's where I think the future lies, or the metaverse, if that's what excites you. When I make that announcement, think about the consequences. I'm spending $5 billion in R&D. What is that going to do to your earnings in the near term? It's going to go down, right? Cash flows are going to go down. I'm offering a trade-off. I'm saying I'm going to reduce current earnings or near-term earnings to give you better long-term earnings. In a short-term market, you should punish me, right? Because that's way out in the future. You want your money now. If you look at what happens when companies announce big investments, Now, I've listed quite a few: R&D, joint ventures, capital expenditures. Stock prices go up, they don't go down. The only exception is product strategies, and that's the emptiest of all announcements, right? There's really nothing behind. Oh, we have a product strategy, great. Put some money behind it, and then I'll react. If companies invest for the future, in a short-term market, they should be punished, but that's not what you see. I told you these are not conclusive piece of evidence, but I think we're too quick to decide that markets are short-term and that managers are somehow these altruistic long-term individuals. But in fact, they're human beings too. They're their own set of incentives. And the same thing can be said about governments and laws and regulations trying to make companies make long-term decisions. And of course, every time you have a crisis, what do people say, especially people who don't like markets? I told you so. Happened in 2008. I told you so. In 2020, between February and March, I told you so. What did you tell me? Oh, you told me markets are the problem? I thought COVID was the problem in 2020, but markets are the problem because they reacted to the fact that the global economy shut down. I thought banks were the problem in 2008, but markets are the problem because they reacted to what banks were doing. And in fact, COVID has been a perfect window to run a test. You know what the test is? What do markets think will happen in the future? What do experts tell us will happen in the future? Through 2020, what were all the vaccine experts telling us? It takes 4, 5, 6 years to develop a vaccine. There's no way, and go back and look at the news stories. There's no way there's a vaccine coming for at least 2 or 3 years. And market said, you know what? I think this time is different. And guess who was right? Markets made that judgment right. All through 2020, you listen to economic experts, they said the damage from COVID to the economy is so dramatic and so drastic that there will be no recovery in employment or production, probably for a decade. And markets said, that sounds a little extreme. I think people will come back, they'll start spending money again. And you look, in 2020, we're almost back to what the employment levels were in February 2020. The GDP is back and above where it was in 2020. I'm not saying markets are always right and experts are wrong. But if you live in a world where you trust crowds, the market is the ultimate crowd judgment, right? Let me ask you a question. When you decide you land in a strange town or city and you want to find a restaurant to eat at, what do you check? I know what I check. I check Yelp reviews. It's a crowd. I don't read the local restaurant review. Is there even a critic in the newspaper who writes? Right? I mean, I don't read because I don't trust those reviews. When I want to watch something on Netflix, it pisses me off that Netflix has no. You notice this? You pick something on Netflix. It doesn't tell you what the star. It used to at one point in time. They've taken it out. Netflix has some horrifically bad shows. I don't want to be sucked up, giving up 6 hours of my life watching Money Heist like I did last year. At 6 hours, I will never get back. So before I even start on a show, guess where I go? I go to Rotten Tomatoes. I look at the tomato meter and I look at the audience score, not the critic score, because I found historically that the audience score works better for me. This is the ultimate crowd judgment. And you might not like it, you might disagree with it, but you can never ignore it. The other class I teach is valuation. The very fact that I teach that class tells you something about what I believe about market efficiency, that markets make mistakes and that I can try to find them. But I'm also open about the fact that much as I say that, I still respect markets. I have to be aware of what's happening and ask the question, when the market moves against me, what might I be missing? Don't be so quick to dismiss markets. They're amazing mechanisms. You can think about it, right? thousands, millions of people come together and they come up with one price for a company with all of this discordant and often inconsistent information. And finally, if you think about the 2008 crisis, the companies that created the crisis were banks. And if you think about banks, they're the most regulated, because if the answer to this is, let's regulate companies, then we won't have crises. That's not true, right? The companies that created the crisis were the most regulated component of the market. I'll be quite honest, I'm not worried about a tech company crisis. Because when tech companies have crisis, you know who pays? The people in that tech company, the shareholders, the kind of air. You don't see the entire market being dragged down because of the connections across companies. So we've essentially shown 3 of the 4 links breakdown: manager, shareholders, lenders, company, and now markets and companies. Let's move to the 4th and final link. In the utopian world of corporate finance, there are no social costs. There are no social benefits. You don't have to worry about society. You know why? Because everything gets priced in. Because everything gets priced in. If you create environmental costs, I charge you for it. You're not getting away from it. If you can create even traffic for other people, in other words, you build a headquarters building right in the middle of some crowded part of the city and you create traffic jams, I can send a bill to you and you have to pay me for the 2 hours I spent in the traffic jam in the utopian world. In practice, you can have all kinds of side costs, right? They can be costs which are environmental, they can be social. And you can also have side benefits. Sometimes what companies do create benefits for society. So in the real world, there are both social costs and social benefits. And of course, you're saying we should bring those into decision making. And that seems like a reasonable thing because we might be shareholders in a company, but we're also members of society. So from that perspective, it seems like a sensible thing to bring in. Let's talk about why it's so difficult to bring social costs and social benefits into decision making. First, the assumption that companies that create social costs know they're creating costs at the time they create them is not true. Let me give you an example. When asbestos was created by John Manville 50, 70, 80 years ago, it was considered to be a miraculous product because all these people who lugged heavy steel and got bad backs and hurt themselves, asbestos was light and easy to work with. It wasn't like Manville started off saying, let's create a product that will create cancer. I mean, even Coca-Cola, if you look at the ads from 120 years ago, they said it was good for your health, that coca leaf and the cocaine kick or whatever you got out of the original Coca-Cola. They thought it was a health drink. So companies create these products and services, they don't think of the side costs. Do you think when Mark Zuckerberg created Facebook in 2008, said, I would like to change a presidential election. That's why I'm creating. He probably created Facebook because he wanted a network of everybody and his friends, and he wanted to, I don't know, expand that network. What I'm trying to say is there might be a point in time where these companies became aware of it, but by then they were well-established companies, and the product and service was already out there. What if we find out one of these days that smartphones make us stupid? In fact, by the time we find out, we might be so stupid, we can't even figure out we become stupid. And then we start suing Apple and Samsung. You can sue as much as you want, but you're not getting your IQ back, it's gone. So lots of social costs and benefits, you don't even know they're there at the time of the decision. You might know 5 years later, 10 years later, and trial lawyers might come after you, but the cost has already been created. The second is the very nature of social costs and social benefits implies that it's in the eye of the beholder. It depends on who's making the decision. As contrast to financial decision, if I said, is a $80 million cost cut better or 100 million? This is a stupid question. Of course, everybody says 100 million is better. But when we start talking about environmental and social issues, it depends on what value system you bring to the table. I remember telling my wife, this was 25 years ago, I valued Monsanto. And I found it undervalued. I said, what do you think? Should we buy Monsanto for our portfolio? And she said, if you do that, I will divorce you. Because she was an environmentalist before it was even. So when she thinks Monsanto, she thinks Roundup, and Roundup to her is the most deadly drug ever created, the deadly poison ever created. So, and unless I wanted to be divorced, I wasn't buying Monsanto. So was my decision affected? Absolutely. So when people talk about we need to bring social issues into decision-making, think about how this is going to play out in businesses. Right? You're 7 people sitting around a table. Should we open the store? And each person brings their social issue. You will have decision paralysis, because this will be like a theology discussion where there's no end in sight. But let's say that cat is out of the bag, or whatever it is that we want as an expression, that we now are in a world where we want to bring in social issues into decision-making. Fine. Let's get real about this. Let's assume you work for Disney. You've decided that social issues matter. And you've decided you're going to open a store in downtown, someplace which is completely blighted. I was going to say downtown Oakland, but it's kind of made a recovery. It could be downtown Detroit, downtown Newark. And I want to make this as clear a choice as possible. I tell you, if you open the store, you will lose $1 million every year for as long as the store is open. And there's no game playing. You say, if I open the store, can I run ads and maybe get more revenues? And no, I'm going to cut off all of this. This is a cost to the company, and there's no potential benefit. But there are side benefits to the city. Maybe there'll be more employment in that part of the city. It'll help revitalize the rest of the city. So you're doing this because you want to do social good. So you work at Disney. In your annual report, you claim to be how good you are as a company, right? I mean, if you read annual reports, companies are saintly. They want to do what's best for society. And I'm holding you on that promise of, hey, you told me you're a good company. So here's my first question. How many of you would be willing to open the store, even though you know that there's no escape hatch, that you're going to lose money and it's going to cost you shareholders value? It's a question. How many of you would open the store? So this whole thing in the annual report, you would? Good. So I have at least one person. The rest of you wouldn't. I have questions for each of you. So basically for her specifically and for the rest of the class. For the rest of the class that said you wouldn't open the store, I'm going to say, what the heck? Why are you telling me in this annual report about how good you are if you're not willing to spend money being good? If the only reason you'll be good is if you can make money, then this is just a PR advertising. That's fine. But don't talk to me about goodness then. It's just a marketing strategy. So companies that claim to be good, but then refuse to spend money on being good, this is greenwashing, right? This is what 99% of companies that claim to be good are. Now I'm going to come to you because you said you'd spend money, right? I have a follow-up question. Would you tell your shareholders that you're making an investment that will cost them money? Let me reframe it. Should you tell your shareholders? You should, right? Because it's their money. Remember that. It's easy to be charitable with other people's money. So when a CEO says, oh, we're going to be charitable and give away 100 million, stop lying. It's not we, it's they. And you're the messenger. You get all the glory, right? You get on the newspapers, hey, I'm giving away, you're not giving away money, you're giving away the company's money. And then you've got to trust that your shareholders bought your shares, not just for the fact that you made money, but because you're a good company. See where I'm going? If we want this ESG crap to become real, companies have to spend money being good. And they have to be willing to trust their shareholders to okay that spending because they've been open about it. That's what infuriates me about this entire discussion. Is first, companies talk about being good, but they don't want to spend money. And if they spend money, it has to be under the surface. They don't want to talk about it. In fact, this entire weekend had my grandson's birthday is coming up in 2 weeks. He's having an Encanto birthday. And my son made T-shirts for all of us saying, let's not talk about Bruno. And my grandson got a T-shirt that said Bruno. Let's not talk about ESG if you're not willing to spend money. If you're willing to spend money, then be open, bring your shareholders in. Because if you don't trust them to be okay with it, then you have no business imposing these constraints on yourself. So let's talk about what can go wrong. So this is a summary of what we've talked about. Managers have little control over, shareholders have little control over managers because annual meetings are tough to get to and too tightly scripted. Boards are rubber stamps. Businesses create side costs and side benefits. Lenders, if they don't protect themselves, get ripped off. Markets are not always rational, and the information they're given is often delayed and sometimes flawed. This is the world we live in. We have a problem because the utopian world is broken down and we're still talking about maximizing stock prices. So I'm going to open the door and say, you know what, maybe there's a better end game here, and I'll offer you some choices. And I'll be honest, at the end of this, I'm going to bring you back to maximizing stock prices, but it's only after I've examined the pluses and minuses. But that's my decision. As we go through these, you might decide that one of these choices is a better one. The first is, so the basic reasons that the process breaks down is managers often put their interests over shareholders. Lenders are not protected, markets are not efficient, and there are social costs and benefits. So let's talk about the alternatives to stock price maximization. The first is maybe we can build a system that's non-stockholder based. And I'll give you some choices. And I'll give you parts of the world where this has been the way companies have been built up. Focus on a different set of stakeholders. Somebody else makes the decisions. The second is maybe instead of maximizing stock price, I should be maximizing something else. Like what? Growth, market share. And finally, maybe I should stay with maximizing stock prices, but find a way to make the leakage smaller. You know what I mean by the leakage smaller? Make managers more accountable to shareholders, protect lenders better, make markets more efficient, find a way to bring in social costs and benefits as financial costs and benefits. So let's start with the first of those choices. Maybe there's a different corporate governance system. You know what I mean by corporate? Somebody's got to be looking over the managers, right? Deciding whether they do a good job or not and firing them when they don't. If you don't trust shareholders, who's that alternative going to be? So I'll give you two countries that in the last century built up corporate governance mechanisms that were not shareholder-based: Germany and Japan. Let's do some history. At the end of 1945, Germany and Japan, the economies were in complete shambles. And over the next 40 years, in true economic miracles, they built themselves back up again to becoming the second and third largest economies in the world by the mid-80s. And they did it with a corporate governance system that was completely divorced from shareholders. Let's take the Japanese system. The Japanese system was built around a system called kairitsus. Kairitsus are companies that have cross holdings in each other. And here's the way the system was supposed to work. Let's say you have 50 companies in a group, they all own shares in each other. The managers of the 50 companies keep an eye on each other. And if one of the companies is badly managed and badly run, the shareholders are not the ones who kick them out. The remaining 49 managers do it. Germany had a similar system with a bank usually in the middle. Daimler was the largest single stockholder. I'm sorry, Deutsche Bank was the largest single stockholder in Daimler. Daimler was the largest shareholder in Allianz, and they all were supposed to keep an eye on each other to make sure that none of them was essentially not, if any of them was doing a bad job, the others would step in. These systems are in a sense elitist systems, right? Because what's the implied message here? Shareholders, the unwashed masses, what do they know? We're the managers, we went to the right schools, we're smarter, we're brighter, we will make the decisions for you. And guess what? They did a pretty good job, right? So if you're thinking about the German and the Japanese system, they look like successes till you get to the mid-80s. In fact, there were a few corporate strategy gurus, and I won't name them, like Michael Porter, but I named them now, who in the late 80s essentially said what's wrong with the US system is this focus on shareholders. That US companies should be more like Japanese companies. That they should create their kairitsus and let managers make the decisions because they seem to be better at it. In 87, that sounded pretty good, right? Japan was riding high. And then you got to the 90s and you saw the downside of these elitist systems. 1991, both US banks and Japanese banks had huge loan problems on their balance sheets that they made to real estate dropped. So in 1991, US banks took their lumps. Basically, they wrote off these loans. Their stock price dropped. The market punished them, but they cleaned up their balance sheets. They were able to move on. You know what Japanese banks did? They circled the wagons. They said, what loan problem? They hoped the problem would go away. And 30 years later, the Japanese economy is still weighed down by the decision because those problems were not dealt with. They stayed, they festered, they affected the Japanese economy for decades. The problem with elitists is elitists. I mean, you might be an elitist. Don't put your hand up if you are. It's not a great place to be. But you probably know elitists, right? People who went to the right schools, the top of their classes. They're very smart people. But you know the three words I hate saying? I am wrong. The problem with the leaders is once they make a mistake, they get locked in. I mean, you can think of wars and how they're started by groups of people. History is full of what happens when you have small groups of people who are very bright people make decisions. The problem with the leaders is they can't back down. Their mistakes become long-term mistakes. So when you think about a different corporate governance system, somebody making decisions, whether it's a group of people at the Ministry of Finance or a group of managers, that's something to factor in. Because when you have these elitist systems, one of two systems come out of it. The first is what I call managerial corporatism, which is companies are run by the managers for the managers. Essentially, they design companies to make sure that their interests are met. This is the benign potential solution. And that's what probably happened in Germany and Japan in 1960, 65, 70. They were benign systems because the managers were not bad people. They were trying to do their best, but there was no check on their part. There's another output that can come out of this system, which is not so benign. I call this crony corporatism, which is the company is controlled by a group of people. It can be a founding family, be a group of managers, and they play the system. Remember all those other stakeholder groups? In crony corporatism, the managers who run the company essentially find ways to get the best for themselves, often at the expense of every other stakeholder group. They write the rules and regulations that govern them. So in crony corporatism, that group becomes the top of the pyramid, and everything in the system is designed to deliver more benefits to them. You could argue that if you take markets like India and you go back 30 or 40 years, I mean, you're public companies only in name. There were family group companies, and the family groups got their connections to essentially make sure the rules were written to make sure that they dominated the business. Until technology came along. In India, you could not start a business without a license. The government gave out licenses, and if you could fix the licensing system, you could make sure nobody ever competed with you. So if you're tempted by one of these corporate governance systems, think about both the benign and the malignant case, and think of the potential downsides. I want you to think about what you think the prevailing corporatism is in China. I'll let you think about it, because there's no way you can make an unbiased judgment here, because it's going to be colored by everything you think. But it's definitely not shareholder-driven corporatism. It's not even on the top 10 list. What is the alternative? Because right now the view is that China must be doing something right. Look at how well it's doing. But you know what the test of a corporate governance system is? Not how well it does when things are going well, but how well it does when things are going badly. That's when you find the weakest links in these systems. So that's the first choice, a different corporate governance system. Here's the second choice. Maybe you can find a different objective. Maximize market share, maximize revenues, maximize growth. And God help you if you call in a consultant into your company, because they will create an acronym that you're supposed to maximize. You have no idea what's in it. But this way you have to call the consultant every 6 months to recompute that acronym for you. EVA, CFROI, you have no idea what it is. Your EVA went up. How do I know? We told you so. And there are companies that say this stock price or shareholder value is too complicated. Let me focus on this instead. That's the upside. It's simpler. It's easier to see. But there's a downside, which is if this metric loses connection to value, you're maximizing something that can actually ruin you. You see what I mean? Let's say maximizing market share is your objective. Would you like 100% market share of your market? Yeah, of course, right? But what if to get 100% market share, you have to sell below cost? Why would you want 100% market share? You're going to go bankrupt. I still remember when Robert Crandall, in 1981, became CEO of American Airlines. And I was watching the press conference. And he said, my objective at American is to make it the #1 domestic US airline. Listen very carefully when CEOs talk, because they sometimes mean what they say and should terrify you. And he succeeded. By the late 80s, American was the #1 domestic US airline in terms of number of passengers flown. But there were only 2 airlines in 1988 making money, and neither of them was called American. One was Alaska Air, because I guess nobody else wanted to fly to Fairbanks then. The other was a small nascent airline called Southwest Air. You know what Southwest Air did? Flew from Dallas to Houston, back again, back again, back again. Why? They were focused on making money. They didn't care about the prestigious flights of flying from air. If you focus on market share and it permeates through the organization, everything the company does is driven by market share, even if it means doing really stupid things. How many of you worked at banks? They do those deal tables where they show you where they rank. My reaction is, oh, you're #2 on the deal table. How many stupid deals did you have to do to get there? Remember, these deal tables don't tell you whether you did good deals or bad deals for your perspective, even from your perspective. They're just big deals. So if you pick a different objective, whether it's revenues or market share or profits or EVA or CFROI, think through the consequences. Think about It's like Murphy's Law. Think about everything that can go wrong with that objective, because I guarantee you in the long term, it will. So before you abandon market price maximization, because it's all this bad stuff, look at the underbelly of these other objectives. And you're very quickly going to realize that, again, there are no perfect objectives. And of course, in the last 30 years, we've got this nonsensical notion of, let's just maximize stakeholder wealth. It comes out of law schools, and I don't want to be biased. Actually, I am biased against law schools. I'll say this up front. Any business idea that comes out of a law school should be shot on the spot, right? It just will not make it. And in fact, they say, well, it's a fairness argument. We have all these different stakeholders. We should be taking care of all of them. And this seems like an easy fix, right? Because if everybody's better off, this is good for all of us. So let's take a look at what the Business Roundtable put out. This is 2019. One of those most ill thought through, badly written statements I've ever seen about the end game in business. Those of you not familiar with the Business Roundtable, 170 top CEOs of companies get together. So this you can think of as a missive from corporate America as to how they're going to run companies. I won't even read the list because I can't keep a straight face while I do it, of what companies are supposed to do. And it sounded amazing. We're going to take care of our employees. We're going to take care of our customers. We're going to take care of, I'm surprised we're going to take care of our competitors too, to make sure that they get a reasonable profit. Seems a little unfair that you're taking market share away from another competitor. Essentially, I call this the kumbaya statement. Let's all get together, gather around a fire and just do a dance. Everybody's going to be happy. And it sounds so tempting, right? What's wrong with maximizing everybody's happiness? Yeah, I'll tell you what ends up happening. And this happens not just in companies, but in personal lives. Now, I have 4 kids, and when they were young, we'd go on family vacations. And if I'd started the vacation by stating the objective on this vacation is we're going to keep everybody happy, you know what the vacation would end up? It'd be completely miserable. You're only as happy as the least happy person in your group. And there's always there's a dementor in every family, right? Sucking all the good stuff out. Not a bad person, but just a dementor by personality. I'll tell you what tends to happen. It's a little late to be enabling transcripts. But in stakeholder wealth maximization, you get what I call confused corporatism. You don't know who you work for. And it's incredibly good for CEOs because you know what happens? They always have another group that they claim is causing the bad performance they had for you. Let me try. I'm the CEO, you're the shareholders. Your stock price is down 20%. You're mad at me. You say, but I had to take care of the lenders and the employees this year. They're doing badly at me. Then the lenders come to you and say, you haven't made your interest payments in 6 months. So these shareholders are putting a lot of pressure on me. You know what? Society needs to be taken care of as well. This becomes your ultimate ass-covering exercise, right? Everything you do, another group is responsible for it. If you're responsible to everybody, you're responsible to nobody. Because in a sense, you can't be nailed down. This is why CEOs like stakeholder wealth maximization, you can never hold them accountable from this day on, because there's always another group that they have to take care of. And if you're tempted to go down stakeholder wealth maximization, this has been tried before, and it's not worked. I'll give you 2 examples. Remember when there were lots of companies that were owned by the government for the public good? I mean, in Europe, it might have been utilities. In parts of the world, it might have been pretty much every product. I remember walking into government companies, and I still do this, and I say, what's your end game? It's amazing when they say, well, here's what we're supposed to do. We're supposed to be a financially healthy company. Oh, by the way, while we do this, We should be investing in other bad companies to make sure they don't go under. Oh, while we do this, we also should be producing products for people who need it. And by the way, while we also, so essentially, you're accountable in a sense to everybody. I know many of you have had very little experience with government companies, but I'll tell you, efficient and well-run are not the words you usually see in government companies. And it's not because they're run by bad managers. You're accountable to no one, and you're pulled in multiple ways. It's impossible to run an entity because each manager, each group picks a different objective. They all pull in different directions. Here's another example of what happens when you don't know what business you're in. Obviously, I work at a university. I work at a research university. And already, if you pay tuition, your stomach should drop. Maybe not as a graduate student, but as an undergraduate student. Because if you think about a university, and you think from the outside, say, what should the mission for university be? What should a mission for university be? What's your end game? It should be to provide an education, right? To your primary customers. Where does NYU get its revenues? This is we're not Yale with a $40 billion endowment. We're a tuition-driven university. And guess where the bulk of our tuition comes from? It comes from those undergraduates. I mean, I'm not sure you pay hefty, I'm not trying to underplay you. But in terms of pure numbers, if you think about customers and revenue, our revenue model is dependent on those 40,000 undergraduates. So if this were a business, and that was my end game, they should be at the top of the totem pole, right? I might not be giving away any secrets because many of you have been undergraduates at other colleges. And guess what? If you thought you were at the top of the totem pole, you're being delusional. You know who's at the top of the totem pole in a research university? It's people like me. I can't be fired. That's what tenure is, an incredibly stupid process. And of course, we use some excuse like some guy in the Middle Ages was burnt by the Catholic Church for holding some, and we said, that's why we need tenure. But let's face it, most of what we think, nobody cares about anyway. Nobody's burning me at the stake because they don't like bottom-up base. I teach 3 classes a year, which is insane. But I'm at top of the totem pole. Right below that is perhaps a link between administrators and assistant and non-tenured research professors. And then you keep going down and down and down and down. And maybe they don't even make the list, but the undergrads are at the very bottom of the list. Have you ever wondered why universities don't seem to be run to make undergraduate lives easier? There's your answer. But here's how it plays out. No research university lives within its means. You know how we know? You probably have already started getting emails from Stern asking you to give back to the school, right? And if you have undergraduate colleges you went to, they don't leave you alone. They call you at night. They call in the middle of the weekend. They usually hire some young, poor junior or freshman to do it. So you feel sorry for them and say, okay, I'll give $200 just to make you feel better. You think, why aren't universities more efficient? Because if you don't have an end game, what drives your decision making? I have no idea still why NYU decides to spend money on some things and not. And my guess is NYU doesn't have any idea either. Because every decision, it's almost on spur of the moment. Let's invent a mission for this statement. Do you want businesses to be run like research universities? We'd all be bankrupt if that were the case. So if you're tempted by stakeholder wealth maximization, think typical university. And then ask yourself, can we live in a world where every company is run like a university? So I'm going to leave you with, you already know where I'm coming from with ESG, but I'm going to pile on. and talk about why I think this is the most overhyped, oversold concept in the history of business. And why there's a gravy train out there that people are making so much money off that you're going to hear more and more about ESG. Here's my first problem with ESG. It promises good stuff for everybody with no side costs. In other words, it's cake for everyone, no calories. Nobody wants to talk about what will it cost you. Second, you'll hear people saying, well, you know what? ESG is good for you as an investor. You can invest in just good companies and make higher returns. Remember your operations research class? You don't, but no, act like you do. In an operations research class, a constrained optimal can never deliver a better outcome than an unconstrained optimal. Saying, what's this got to do with ESG? If you're an investor, and I tell you, you cannot invest in bad companies. You cannot invest in fossil fuel companies. I'm thinking of buying Aramco, so that'll make me think about the anti-ESG company now off your list. That's a constraint, right? If you're telling me that your constrained optimal delivers higher returns than an unconstrained optimal, my mind is already twisted. I don't see how that can be. But that's the pitch you're hearing, right? You're hearing it from Larry Fink, you're hearing it from the investment funds. Just invest in our ESG fund. Not only can you be good, but you can make higher returns. And of course, we're told, even if none of this stuff works, it's not good for companies or investors, it's good for society. We're doing the good work. We're like Franciscan monks. We're making the world a better place. What a bunch of crap. Let's start with the first place ESG started. To first decide we're good or bad, somebody's got to do the measurement. Already we have a problem, because that somebody is going to be a service. It's Morningstar, Sustainalytics. There are like 5 or 6 different competing services. They all come up with ESG scores. You know the first thing you notice? They don't seem to agree. Does that surprise you though? If I went around this room and said, tell me what you'd look for in a good person, there is 0 chance of consensus, because it depends on what you value most and what your culture, where you grew up, what your family background is, what you think is good and what you think is bad. So the first problem with ESG is measuring ESG. It's like nailing Jell-O to a wall. It's not going to stick. For a while, Facebook was one of the highest ranked ESG companies on many services. You know why? Because there's no carbon emissions. You're saying, what's that got to do with things? For a long time, ESG scores were so focused on carbon emissions and climate change that if you're a company that didn't create those, you're a good company. Why do you think tech companies end up at the top of the list of almost every ESG service? So the first problem with ESG is measuring it. There's no agreement, and there will never be an agreement. It's not like you learn and get consensus. Second, when people talk about ESG being good for companies, my reaction is from a Burger King commercial 40 years ago. Where's the beef? Show me the evidence. Because when you look at the actual evidence, here's what you see. You see a very weak link to profitability. It's true that companies that score higher in ESG tend to have higher margins. But before you get too excited about this finding, what if I told you? Because people read that and say, well, that must mean being good makes you more profitable. What if I told you that shopping at Whole Foods will make you richer? You think that's absurd? You know how I'd back it up? I do a correlation between how much money you spend at Whole Foods and what your income is. And guess what I'm going to find? A really high correlation. What am I missing? It's not shopping at Whole Foods that makes you richer. It's being richer that allows you to shop at Whole Foods. So big question with ESG is, are companies that are good being more or is being more profitable giving you the capacity to do the stuff that makes you score high on these ESG scales? If there's any good news in the data, it is that there is a link between ESG and funding costs, but it's mostly in the fossil fuel business. Fossil fuel companies in the last decade have faced a problem. Investors are pulling their money out of their stocks. The price goes down, which pushes up the cost of equity. And with green bonds, you might actually end up with a higher cost of debt and a higher cost of equity if you're a bad company. You know how even if that were my primary evidence, you know what I tell companies? Don't be bad. If they say, look, should I spend money being good? Once you get beyond that bad group, and for the moment, as I said, it's mostly fossil fuel companies, even that link breaks down. And there is evidence that if you walk too close to the line in terms of being a bad company, you can sometimes wander over the line. Right? I mean, I remember valuing a company called Valiant 5 years ago. It's a Canadian pharmaceutical company. I'll describe its business model, and you tell me whether you would be willing, if you worked at Valiant, to describe this business model to your elderly aunt sitting next to you at Thanksgiving. Here's what Valiant did to make it one of the most successful pharma companies the last decade. It didn't do a lot of original R&D. What it would do is go buy a drug that was already patented and approved, maybe 10 or 11 years, a drug that was designed to serve a small group of people, so a drug for a fairly rare disease. It'll buy the drug, and after it bought the drug, it would increase the price, threefold, fourfold. That doesn't sound like a business. If you have a business model that you cannot tell your aunt about, maybe you have an ESG problem. In the case of Valiant, that model blew up. And when it went down, the company went down with it because it turned out that no scientist would come to work in their R&D department. In fact, their name got so toxic. You know what they had to do? They're still around. They took on the name of one of their divisions, Bausch & Lomb. Valiant is now called Bausch & Lomb. So if you look at companies, do you find evidence that being good increases value? Not really. Do you find evidence that being bad could hurt you? Yes. So take that for a starting point. Let's not be bad, but being good doesn't necessarily pay off. I'm going to stop there, and I'm going to come back and dump on ESG a little bit more on Monday before we move on to the meat and potatoes part of corporate finance. So I'll see you next week.